variety of perspectives in a one-owner business of any kind, right? I mean, to the extent that lawyers can ever be said to do anything simply or inexpensively, we do one-owner businesses fairly simply and inexpensively. It's just typically not that complicated, from an accounting or a tax perspective unless you just really screw that up. And in terms of a lot of the other things that we're going to talk about, it's just not that complicated to have a one-owner business because we generally assume that the odds of you getting into a dispute with yourself are relatively low. I'm not being facetious about that, but I mean that's the fact. All right. So I will tell you that when you go from one owner to two owners, you much more than double the complexity of your enterprise because there is now another human being with whom you have to deal. And that creates sort of a whole, going from two owners to three owners isn't terribly that much more complicated. But going from one to two creates a lot of issues. So this is mainly in the context of businesses that are going to have multiple owners. And when I'm sort of sitting down with someone who comes in and meets with me and says, we've got a real estate project plan, and I would say I'm seeing two people sitting on that side of the table. We have a real estate project plan. This is sort of how I'm going to start thinking about it and what we're going to start talking about with them. And I'm going to probably start out talking about, on this first topic, how are we going to run this thing? Okay, on a day-to-day basis, how are you going to make decisions? Who's going to be in charge? Who's going to be in charge of what? Is one person going to be silent and passive and maybe just providing financial backing? Is another person sort of going to be active in the business and providing sweat equity? If there is ever something on which the partners don't see eye to eye, how are we going to resolve those kinds of conflicts? Particularly if you come to with a 50-50 deal, what happens if the 50 and the 50 don't agree on a particular issue? How are we going to deal with that? So we're going to sort of work through all those issues. And after we kind of sort of wrap our arms around that, the next thing, of course, we're going to talk about is going to be money. Okay, and we're going to talk about everything costs money. Where's the financing from this project coming from? You got a bank loan? You going to put any equity in the project? Where's the equity coming from? Who's putting the equity? What form is that going to take? Is somebody sort of putting sweat equity in the project? How much credit are they going to get for that financially? How's that going to work? How are we going to document this? There's sort of a whole host of issues that we'll work through on the topic of the money. And of course, with two owners, we've got buy-sell issues. And so, at the simplest level, if we had two people there who are going to own this particular project, I'm going to say, God forbid, one of you gets run over by a bus, what's going to happen? Okay, is the surviving owner now going to be in business with the spouse or children of the deceased owner? And what's that going to look like? Is that going to work well? Is it not going to work well? Let's say one of the owners needs to monetize this asset and pull out cash and wants to sell their interest to somebody else. Can they do that? Do they have to bring it to you first? If they have to bring it to you first, do you have to pay the same thing the third party would pay for it? So we're going to work through those kinds of buy-sell issues that exist when you have multiple owners. All right, now I'm going to stop there, and I'm going to say these first three issues are all very important issues, okay? And there's certainly things that we would have to work through, all right? None of these three issues, the management, the financial side, or the buy-sell issues, none of those three issues is ultimately going to drive our decision about what kind of entity we actually use for this project. Okay? And the reason why none of those issues in and of itself is ultimately going to drive that decision is because a good lawyer can take virtually any kind of entity that you can come up with and get on the computer with a little drafting, reach whatever outcome you want to reach on any of those three issues. I can take a corporation, I can take a C corporation, I can take an S corporation, I can take a partnership, I can take an LLC, I can take a limited partnership. You name, we can take a co-tenancy, a group of co-tenants who each have a fractional undivided co-tenancy interest in the property. We can take all those, and I'm telling you that we can draft around just about any problem you can think of in those three areas, okay? So it's not that those areas aren't important, and it's not that I'm not going to focus on them. We are going to focus on them. But ultimately, ultimately, what's really going to drive the decision about what kind of entity we're going to use as between all those options is probably going to be largely driven by those last two issues, which are owner liability and tax treatment. And the reason for that is because those are two aspects of the business that we're all stuck with, okay? The government sticks us with the outcome on those, okay? The government says, when I say the government, I mean the law of the land. The law of the land says that if you're a general partner in a general partnership, you're going to be jointly and severally liable with every other partner for all the obligations of that partnership. Personally, fully, jointly, and severally liable for everything. I'm stuck with that. I can't do anything about that, okay? That is what it is, all right? And so if we sit down and we meet and we're talking about your deal and Gail, is it Gail? And your name? Gail and Paul come to me and they want to start a partnership or have some business to buy some investment property, and Gail and Paul aren't interested in being jointly and severally liable with each other for everything, guess what we're not going to do? We're not going to do a general partnership. Okay, we just decided something there because that won't work, all right? Likewise, on the tax side, you know, there's tax planning that can be done in most situations and with most different kinds of business entities. All right, we're always looking for ways to achieve tax efficiencies, but you sort of reach a certain bottom line beyond which you can't go in tax efficiency and tax planning, and you're sort of stuck with the tax and accounting rules. Okay, so depending on what tax outcome we want, that's going to have an impact on what entities we're going to use. All right, and we're going to talk about that more in a few minutes. All right. So let's start with, since we're stuck with tax rules and we're stuck with liability, let's start talking about taxes and liability first. And I'm going to go over some simple rules for how to structure your real estate investments. And rule one is we don't use C corporations. All right, we don't use C corporations. And I will say we don't run into this very much. And hopefully none of us in the room are currently using C corporations or have one that you're using for a real estate business. But we don't use C corporations because they're a very tax inefficient way to own real estate. Among other things with C corporations, ultimately when you sell the property and you sell it for a profit, as you want to do, you're going to get hit with 2 layers of taxation, both at the C corporation corporate tax level and also at the individual level. It just results it just doesn't work. All right, so we're not going to use C corporations. Now, sometimes people then say, well, all right, I know we don't use C corporations, but what about S corporations? S corporations are pass-through entities. My accountants told me that an S corporation might not be a bad thing. We don't use S corporations for real estate either. And using a C corporation for real estate is like cataclysmically stupid. Right? Using an S corporation for a real estate deal is merely a bad idea. Right? And the reasons not to use S corporations are more technical, but one of the main reasons why we don't use S corporations in real estate is with an S corporation, there are different basis rules for S corporations than for partnerships. And so if you own real estate through a partnership, the partners get to include their share of the partnership's debt, its mortgage debt, in their outside tax basis in the property. All right, that's a good thing. Tax basis is a good thing because you can use that tax basis to take depreciation, and to the extent you got basis when you sell the property, it reduces your gains. So we like tax basis, I like outside tax basis. With an S corporation, the shareholders in the S corporation do not get to include their respective shares of the S corporation's mortgage debt in their outside basis in their S corporation stock. So you got this basis strip where you lose the benefit of this debt created basis just because you used an S corporation. And we could come up with, we could run numbers and come up with examples that I could show you where it makes a big difference. Yes, sir?
One quick clarifying question. The real estate business that you're talking about, are you talking about a business that holds property or that flips property or that does both?
That's a great question. I'm glad you asked that. And that's probably a good question to get out of the way now. I am primarily talking about a real estate business that is an real estate asset business and not a real estate services business, okay? So I'm not really talking about a management company per se, where if I'm looking on the balance sheet of the management company, what I'm going to see is receivables and payables and cash in the bank, but I'm not going to see real estate. I'm talking about a business where if I look at the balance sheet of the business, even if it buys and flips, it could be buy and hold, buy and flip, but if I'm looking at the balance sheet of that business and I'm seeing real estate on that balance sheet, that's really what I'm mainly talking about here.
Even if it's, flip a month or two later, so it's all short-term capital gains, these rules still apply. But if it's a wholesaling business, and you don't see real estate on a wholesaling business all the time because you're signing contracts and getting paid a fee for that, these rules may not apply.
These rules, it would be to the extent we're talking about fee-driven ordinary income, we'd have a somewhat different analysis. I'm actually not sure we come out at a different place on any of these things, but we probably approach the issues a little bit differently and have a little bit different discussion.